the Executive Director of SEBI, Mr. Vaidyanathan, members of the Motilal Oswal family, Mr. Oswal, Mr. Ramdev Agarwal, members of the National Stock Exchange, welcome to this ETF Conclave. David, you may be familiar with this, and Balaji, since both of you are from America, that in the 90s there was this aha moment when James Carville, who was the election manager for Bill Clinton, said that if he was reborn, he wanted to be reborn as the bond market. Because the bond market dictated policy, what the deficits were in America, what the tax rate should be in America, what the inflation rate should be in America. It was omnipotent, more important than Congress, more important than the president. The bond market controlled the financial economy. And switch forward to 2010 onwards, and the new financial kid on the block is ETFs. They run over $1 trillion under assets for a product that didn't exist about 10, 12 years back. There are more than 800 ETFs that trade in the US. So it's a very important and increasingly dynamic force that shapes financial markets, can cause rapid movements in various assets and commodities, whether it's gold, silver, or equities. The fact that whether it's rightful or not, be blamed for the flash crash explains how important ETFs have become part of the financial language of the world. So let me just start with a very basic question. When I was trying to understand ETF, the first question came up, and I'll ask you, David, and then I'll ask you, Nitin, about this, is that what is the difference between a closed-ended fund that trades on the exchange and an ETF?
Well, they both trade on the exchange. A closed-ended fund will not have a creation and redemption mechanism that enables the fund to issue new shares. So a closed-end fund starts out with an issuance of shares, and those shares are generally fixed for the life of the product, except for secondary offerings and things like that, but generally. And an ETF has what's called a function called continuous issuance. So every day in the life of an ETF, authorized participants or market participants can create new shares in the ETF or redeem shares that they have. What this does is critical because it enables the ETF to trade right around NAV because there's an embedded arbitrage mechanism. It's one of the last remaining pure arbitrages, if you think about it, because especially in an ETF where the basket and the ETF are trading at the same time, there's a pure arbitrage between those two products. And I think I refer to them as completely fungible. One really equals the other. That does not exist in closed-end funds.
Is the Indian investor at this point sophisticated enough to understand the difference between a closed-ended fund and an ETF? And David points of that true arbitrage can be created. Just explain that in a example.
So I think the Indian investors were very used to closed-ended funds till about 15 years ago, and one of the reasons why closed-ended funds became out of fashion was primarily because you would invest in them and you had no ability to take your money out unless you could find a buyer on the exchange. On the exchange, when you would try to sell the fund, it would typically trade at 20, 30, 40% discount to the NAV, which effectively means that you're losing a fair amount of value that has been created in the fund, or even if it's not been created, you're still losing value. And I think that's when they became out of fashion. What ETF does really is it blends the listed feature of a closed-ended fund, but gives the ability of an open-ended fund to then create and redeem units on a daily basis, just like you have on the mutual fund side. And because you can sell and buy ETF units on a day-to-day basis, this 20, 30, 40% discount shouldn't exist and doesn't exist. Yes, you will still have a 1-2% difference between the ETF price and the NAV, but that's a function of market supply-demand. To give you an example, if you take any Nifty ETF or mid-cap ETF, if the NAV of the ETF is 8 rupees, because you know the underlying 100 stocks and you know what price they trade at and what the composition of that basket is. If the NAV is 8 rupees and you see the market price to be 9 rupees, then there is a 1 rupee, as we call it, free lunch available on the table.
Arbitrage
opportunity. This is a pure arbitrage because this is risk-free arbitrage because you could easily buy one and sell the other. And that feature basically lends the ETFs to be effectively track the NAV pretty much as close as possible. And I think that's pretty much what ETF as an innovation has managed to do.
Right. Balaji, let me get you in on this. While theoretically that's true, of course, that any arbitrage should be discounted away by the market participants. In the US itself, from which you come at Credit Suisse, a lot of the ETFs have a huge tracking error. For example, the USO oil fund, it traded a 62% discount to its asset for some reason, or a banking fund that I read in David's book, or some other book, where, it used to be a short ETF fund, and actually it underperformed the long fund when the markets was going down. Why is there a tracking error then? Is it just for a specific type of fund, or is it across ETFs?
So I'll just give a clarification on USOs since you asked. USOs is not a equity underlied product. It's a product that uses futures as an underlier.
But it's an ETF.
It's the purest form. It's not defined as an ETF. Many purists will say it's not a 40 Act fund or a SEC regulated fund, even though SEC blesses it and has to be approved by it. It's not a pure ETF in the purest sense. And it doesn't track oil. It tracks the futures on oil. So the supply and demand on the futures over the spot price over the ETF is what creates the arbitrage opportunity. And on a fungibility basis, most of the stock-based ETFs are completely collapsible. On a commodities-based ETFs, it may not be, especially the ones that track futures or options.
Because the contango charges would vary dramatically in that case.
On the short side, on the short side, most of the short ETFs have a daily resetting provision, which means they track a compounded daily return. It doesn't have to have reality of point A versus point B.
So as a rule, there's not much tracking error problem in ETFs.
Correct.
As a broad asset class, it would track the underlying.
Correct.
That has been your experience?
Correct.
Correct. Okay. David, I was reading your book, The Handbook of ETFs, and there's a very famous Kevin Costner line in there that build it and they will come. Explain that to me. I mean, does ETF have to be seeded in the market?
What happens is with an ETF, you do not launch via, in the U.S., here it's different, but in the U.S. you don't launch via an IPO process. You launch with a very small amount of assets and then you wait. So as an issuer in the U.S., you take on the entire responsibility of bringing an ETF to market, right? You build an infrastructure at your firm, you get regulatory approval, you develop marketing, and you bring an ETF to market with no assets typically, or a very small amount of assets. You have taken on all the risk, you build the ETF, and then you wait, right? You send your marketing team out, and they have to go in and find investors for that ETF. It's a very hard process. It's daunting, right? When you look at all the ETFs that have come out, and like I talked about, all of those ETFs that have not raised a lot of money yet and that are in the incubation stage and don't trade a lot of volumes, there's a lot of expense in keeping those ETFs in the market, right? In the market here, you have the IPO process to start, and I think that gets ETFs off to a better start at the beginning as well, because investors are always comfortable if they see an ETF with some assets in it to begin with.
Correct. Balaji, but isn't there a risk that because it can grow in virtually unlimited sizes once it is spudded or seeded there, that it encourage short-termism? If gold is the flavor of the month, all retail investors will move into gold, institutional investors will move into gold. So actually, rather than tracking the underlying, it becomes the cause for the underlying to go up because so much money is coming into the ETF. Is that a risk in ETFs?
Let me put it slightly differently. The ETFs can never outperform the underlying shares. So for example,
can cause it to move up in itself because so much money is coming into a gold ETF, so the ETF person will then go out and buy the physical gold as the underlying.
Correct.
Which will cause a demand for it to go up anyway.
The other option for the ETF provider was to buy the gold. There is a reason why he comes to the ETF market, right? ETF market is more liquid, and maybe there is a certain amount of liquidity premium that goes up, but it's a market mechanism that's going to naturally adjust itself. If ETFs didn't exist, that investor would have directly gone to gold. Maybe you wouldn't have gone to the gold wholesale market. Maybe you would have gone to the gold retail market. So the cost of gold moving up or securities moving up, it's not going to be the ETF.
David, a lot of these commodities can't absorb the kind of money that the ETF can raise.
No, I actually don't agree with that statement. I agree completely with Balaji. The ETF, the existence of an ETF is not driving price because, like I tried to express in the talk, all an ETF is a wrapper. everything is driven by that underlying basket, right? So when people want to buy gold or oil or any other commodity or anything like that, they're going to buy those things, and the demand for those products is what's driving up prices and creating, mini bubbles or whatever you want to. It is not the ETF. The ETF is actually an easy and efficient vehicle to get that access, but it is not driving that price.
But the presumption here, though, is that an individual investor can now become an institutional investor. He can take a macro view of the world. He can say short dollar, long gold, long Deutsche Bank. Is that what it allows an individual investor to do in ETF?
Yeah, well, yeah, ETFs are tools, right? I mean, I think you should have the ability to go to, a hardware store and buy any tool that you want. You may not know exactly how to use it, and it's up to you to be your own advocate to learn the proper way to use that tool effectively. But I think tools should be available to people, however they are. And in a way, an ETF is a toolbox, and you'd like to build a big toolkit, so you should have as many options as you can.
I think the point he's trying to really make is that ETFs can be used to build portfolios instead of using just underlying stocks or bonds. Obviously we have seen the markets in India very much used to buying individual stocks. When mid-caps are in flavor, everybody wants to know the top 5 mid-cap names to get exposure to. But why not have an ETF that actually gives you exposure to that basket and hence create access into that basket? So if you have enough of these access tools available, then you can decide what should be the core of your portfolio and what you want to go overweight or underweight. And effectively, it's really a toolkit that you can then use to paint your own picture.
So, correct. So, to explain it in other words, India is a very simple market. You could buy equities, or you could buy real estate, or you could go and buy physical gold. Now there's a way to express yourself through the financial markets and ETF products?
Yes, I think we've just seen the beginning of that with equity and gold, and as Mr. Vaidyanathan made the point, we still haven't seen, for example, the ability to buy fixed income through an exchange product or any other commodity except gold. So I think over the next few years, hopefully we will have enough of these tools available across different asset classes. So when you want equities, you should be able to find enough equity options. When you want fixed income, you should be able to find enough fixed income options, and so on and so forth. So yes, I think we are going to head in that direction.
Yeah, Balaji, what is the experience in emerging markets with ETFs? I mean, can you give us some light on that? Hugely popular product in the US. Have they caught fire anywhere else in the world?
They have. China and Singapore have a number of emerging market listed products. And the local markets are all thriving. They're all coming up right now. But the biggest ones, of course, are in the US. Europe is a nascent market right now, but it's going to probably light off. David can throw some light into this. But the investors in those markets use it as an access product. We have not launched products in India yet that gives them access to, say, Thailand or Malaysia or Singapore. Once we bring those products in, those products will take on.
Okay. Nitin, what kind of infrastructure do we need in India to make this ETF more popular? I mean, someone who runs an asset management company who've already introduced these products, what prevents us from letting 1,000 candles burn?
I think in my mind, there are two key things that we need to do. One of them really is to continuously give the message out as to what ETFs are, because anything that is the fear of the unknown. When I can buy Reliance and State Bank and HDFC Bank, why should I really worry about buying an ETF that I don't know about? So clearly, information dissemination is one key part, and the second key part is some of the market infrastructure development that needs to continue to happen. For example, professional market makers. I mean, yes, we have within the firm at MO, we have a fairly well-developed, market making desk, but I think we need 5 more, 6 more, 20 more of such desks. I mean, David had the chart and he named a few firms. I think if all of us thought together, we wouldn't come up with more than 4 or 5 names that do something like that here. So I think we definitely need to see some of that develop. And finally, I think we may also want to wait for some of the tax issues to get sorted out. For example, STP actually ends up eating into a lot of the benefits that products like ETFs bring to the market. So it's slow and steady. I think we've made a beginning. We will see new products launch in new asset classes, as I mentioned, and then hopefully some of these things will continue.
Just explain the tax consequences in India of an ETF, please.
ETFs are taxed as equity ETFs are taxed as an equity stock or like a mutual fund, which is the same treatment. So you have to pay STT on every ETF trade that you undertake. which is all fine because you anyways pay STT on when you buy equity. But what happens is for a market maker who's effectively trying to keep the spreads as close as possible, it just adds a cost on every trade that he has to put together. Because if he sells you the ETF units, he has to then buy the underlying basket. So he pays STT on that. If he then converts the underlying basket into an ETF, he pays STT on that as well. So effectively it adds up. A lot of fat gets added in the spread. Roughly 25 to 50 basis points only costs for the market maker. From the point of view of the investor or the advisor, his view is, well, I really don't want to see a spread beyond 1 paisa if possible, and I should be able to buy as much as I want in that 1 paisa spread.
Right.
So it's a chicken and egg story to some point, but effectively I think that's really one of the biggest bottlenecks that we have that we need to address, and we obviously we're working closely with the right forums to make that point at least.
The SEBI director was here.
Yeah, he's well aware of that actually.
When he says jump, we say how high. So
yes.
The couple of questions that he raised, let me try and get that to you. How do we make ETF a mass product? And David, you have a lot of experience in this product. In India, if you were to get down, he said, make ETFs on liquid funds, make ETFs on
fixed income products.
Fixed income products. Give us your thoughts on that.
I think he was, and when I started speaking, I said that was a great speech. I think he was spot on in that when bringing ETFs to market in India, you're going to have to build products that address the actual need of the customer base here. It's not going to be a process of looking at the U.S. and creating a carbon copy here, like we built cities, like he was referring to. This is a process of tailoring products that will fit the needs of the investors here, and that's what's going to drive growth. And I think for him, that's where you'll get that scale. So it's not everyone is going to need a certain product, but there are going to be products out there like the liquidity vehicle that everyone will need, and if you can bring it to the people in this efficient vehicle, I think it will,
Balaji, you have some thoughts on this matter?
If you see the graph that you showed, David, you had professional traders as one of the main columns. I think that's a key constituent of having people having that constituent. I don't think that constituent is developed well. You develop that, what it happens is it adds not just liquidity, but it adds volume. Liquidity and volume are two different concepts, as David was making a point. And once you see volume, people will come in. You build them, they'll come. So people are still worried about, one is education, liquidity and volume are two different things. And in reality, putting the volume and keeping the arbitrage tighter and tighter and tighter, that mechanism needs to develop, and it will develop over time.
Actually, just make 2 points to the same thing. Let's take the example of existing products that we have in India. Let's take a lot of the broking clients that we deal with on a day-to-day basis, and every day they have a certain amount of money that is available in the trading accounts, and it's the decision that they need to make whether they buy something or they sell something. Assume that you didn't like anything you wanted to buy. At 3:25 p.m. you still have 1 lakh rupees in your broking account. You do nothing with it. Who makes most of the money? The bank does, because the bank gets free overnight money at 4%. Even though they've increased the savings rate, but they still make a potload of money on that. If you had the ability to then move that money at 3:29 into a listed product that gives you at least an 8% return because it's a liquid fund, and that's what we're getting in liquid today, then you actually get 4% more return for as long as you stay in it. So that's one simple, it's something that we've seen, but it's one simple expansion of the market product that can happen.
So Nitin, given the fact that our savings rate is very high, and the portion that goes to equities is 8%, the next product should be a liquid fund?
Absolutely. I think, something that we will definitely, we've been exploring. In addition, let's take another very, very popular product that almost everybody in this room would have bought, which is an FMP. The attraction of an FMP is that it gives you the ability to lock into, a 1 year, 2 day, 3 day, 5 day interest rate. Especially today, you can get 10% and, without any hassle. But you have to wait for the right series to be launched, and every day you say, okay, what is available today? Why not then create a product that effectively becomes like a listed, you wrap the FMP into an ETF-like structure. And I'm just thinking aloud here, but effectively every day you have the same benefit of capital gains versus income tax. And that's why FMP is important, because it's more than 1 year, closed-ended, it's listed, and so on and so forth. So I think there are many ways we can take the existing product sets and wrap them in a structure that makes it scalable and expandable. And I think that's what we're trying to focus on over the next phase of our growth as well.
Yeah. But at the soul, an ETF should track an index, shouldn't it?
That's a old concept, right? Now, David will disagree with me and he says that we have lots of actively traded products. So, most of the ETFs that are in existence today track an index or a commodity or a well-known entity in one form or other. But there are up-and-coming actively traded ETFs where the managers have discretion of what they buy, what they sell. Even though it has to be disclosed and the constituents have to be disclosed,
when?
Every day.
Every day.
At the end of the day?
Every day.
But that would mean that the arbitrage would immediately widen.
No, it'll shrink at the end of the day.
If in the middle of the day the fund manager sells IBM and buys Microsoft and you don't know
they'll
about
have to
that.
give an advance notice before they do that. So they will disclose
In advance, a day in advance.
advance.
Not a day after, a day in advance they will give the notice.
They will give, most of them they give you what the constituents are or what the changes are going to be well in advance for all the market participants at the same time.
But then isn't there a risk of front running those things?
That's the same concept of index changes. MSCI today announces what index changes are going to come in ahead of the index changes coming in. There is positives and negatives are trying to beat that index, and that's okay.
Is that correct, David? Is that your view also of actively managed funds?
You know, it's interesting. If take a currency fund, for example, there is no index on a currency, but for investors in India who maybe want to play the Brazilian real and they can't trade actual real in the currency market, an ETF would be potentially a great advent for them, right? And there is no index on that you could issue, so that would be a prime candidate for an ETF that doesn't have an index benchmark. Those are the types of places where the underlying is hard to mimic in an index that makes sense for actively managed ETFs. And one thing to realize is that the actively managed ETFs that exist today are typically or are still all fully transparent, so they show you those holdings every day. But also the ETF structure is all about low turnover. So actively ETFs are not doing a lot of intraday trading in the basket that people then have to re-replicate the next day. Most of the funds that are out there are some form of rules-based active management, and that's why they work in that structure.
Actually, I think there's a very important point that we kind of forget in this whole issue about index versus active. Today, when you put your money in a mutual fund, you actually have no idea what your fund manager is doing with it, except seeing quarterly statements. And some managers declare monthly statements, and some of them will give you top 10 on a daily basis, but that's rare. So when you can trust a manager with an opaque structure, not knowing what he's doing in the fund except seeing the NAV every day, why wouldn't you trust an ETF which tells you what's in the portfolio every day and still let it trade on a daily basis, on an intraday basis? So I think the benchmark really has to be not index, but essentially what's going on inside of a fund. And if I can see it, if I can trade it, I can track it, then I think it should really become irrelevant whether it's an index fund or not an index fund.
But the point you're making is that a fund manager will give you 24 hours prior notice.
In most cases, you will have certain constraints.
Otherwise, you can't track it, right?
In most
you can't arbitrage it away.
Or rules-based.
In most cases, there will be a certain constraint that you will already declare upfront. For example, I may decide to do an actively managed, for example, the liquid fund. I'll say I'll only buy these following types of securities with these types of maturities with these types of ratings. So effectively, I've already put full constraint, and the final selection is then made public on a daily basis.
All right.
So I think, again, it's not really about active versus passive. I think it's really about, can we use the ETF structure as a wrapper and create more and more products that may or may not be able to be accessible as an index.
Yeah. Typically, when an ETF lists, you will have authorized participants.
Yes.
Explain the role and how they would work.
So the role is a little less developed in a market like ours because everything is kind of dependent on that one authorized participant. But effectively, these are the people who will translate the underlying baskets into the ETF units on a day-to-day basis. So they are what we call the wholesalers or the primary dealers that will come to us, deal in those wholesale lots that we create, and then sell them in the market. In some cases, they may hold an inventory. If they do, they will charge a slight spread because that's cost of holding the inventory. In some cases,
to whom is the spread charged?
To the two-way quotes that they give in the market. So if the ETF NAV is 8 rupees, going back to the mid-cap ETF, which it is today 8 rupees, ideally his bid should be 8.99 and offer should be 8.01, ideally in an ideal world, and the NAV should be right in the middle.
799.
799 and 801, sorry.
That would be hard.
Right. 799 and 801 because the NAV has to be right in the middle.
Right.
But in an ideal world, if he's been holding the inventory for long, then he'll say, if you want to buy from me, I'll charge you a premium. If you want to sell to me, I'll give it to you at a 2 paisa discount.
Right.
So that obviously he will charge to the market.
Right.
And that's for the convenience that he's giving you of breaking a wholesale lot down into a retail lot. It's the same thing, when a bank can hold government securities, but it pays you only half of what they earn with RBI. So it's a similar concept to that. So that's one role that they will play, which is to actually convert ETF units from wholesale lots into retail lots. And the other role they will play is to constantly continue to arbitrage the spread between NAV and the price.
So he'll make money both ways. He will do the spread, and because he offers a service, he'll buy the underlying or sell the asset out there. Has it worked similarly in the US? I mean, are the market makers, is it primarily a NASDAQ product or American exchange product?
Well, no, most of the ETFs in the US are listed on the NYSE ARCA. 90% or more are traded there. But really in the US, it's as a trader, it's very hard to tell where you trade anymore. It's, in the old days, people used to say, I want to trade this specifically on New York. It's not really like that anymore. You just trade, and it happens on the primary exchange for the most part. But I think one thing that's critical to understand about the creation and redemption process and the role of the AP is that investors should not even be burdened with knowing too much about that process. It's really a back office functionality to enable liquidity providers to manage their positions and manage their balance sheet risk. They should be able to provide all of this liquidity in ETFs, put on all of their hedges, and then utilize the creation and redemption mechanism to flatten out their positions overnight so they can do it again in the next day. And that's the way that process is designed.
Is that
absolutely? I think in an ideal world that is the way it should be, but again we don't live in an ideal world and we are still evolving. So what we've done is we've broken down the size that you can create with us to a very small number. It's small enough that will allow us to buy the basket, but still large enough from a retail investor point of view. But I think a lot of the discussions we have with advisors and brokers is, well, and a lot of the advisors are saying that if nobody else is willing to do it, actually maybe I should do it because I can afford to invest 20 lakhs and make 1% on it pretty much overnight. I'm happy with that return. So I think we've broken down the lot to a much smaller size only to enable, in absence of true market makers or a limited number of market makers, to enable that process to be more efficient. But really it's a back office process. The investor shouldn't really have to worry about it, ideally.
I'll ask all three of you this question, and the underlying principle here is that capitalism is Darwinism, that the big eat the weak and the strong survive in this matter. You have a financial landscape where you have mutual funds, you have now ETFs, you have closed-end funds. How does the landscape look 10 years from now? Does ETF become the vehicle of choice for most people, or can all these things coexist in a world? David, I'll start with you.
I'll give you an example. A personal example is that in 2001, I sold all of my mutual fund positions and converted all of my own personal assets into ETFs, and I'll probably never own another mutual fund in my investing life. I think
we know where you stand now.
Yes. Yeah. So I probably don't even need to give you any more from there.
No, but do you think, for example,
I think that ETFs will continue to grow, and that as investors learn to understand the products and the benefits. Look, an ETF is a mutual fund at its heart, right? It's a mutual fund with modern advantages and benefits and efficiencies that didn't exist when mutual funds were created. And the same thing goes for closed-end funds as well, right? All of these things weren't conceived of or possible at the creation of those products, and the ETF is just a newly formulated version of that. And I foresee that as the investment choice of the people going forward. Yes.
Give me some numbers, at least to understand in the U.S. What are the funds under mutual funds right now, the assets under management, and assets under ETF?
I think roughly, very rough numbers, you'll see about $12 trillion in mutual funds and maybe close to $2 trillion overall globally in ETFs, so maybe $1 trillion plus some in ETFs. So roughly 10% of the whole thing is 10%. ETFs are about 10% the size of mutual funds. I see them over the next few years, I mean, you've seen some statistics come out from ETF researchers that say that ETFs will double in the U.S. By the end of 2012, and I actually think that growth is going to continue to grow at a very fast pace, actually picking up in the next few years because people are adopting the products much quicker. So I think you'll see that percentage get up to a much more significant percentage and assets in mutual funds drop correspondingly.
If you were a betting man, which year would you say it'd be 50-50 with mutual funds and ETFs?
2017.
In 5 years' time, 6 years' time, you'll get there. Does big mutual fund houses in America today, like a Fidelity or I know Vanguard offers it. Do they offer ETFs, or is this?
They're getting there. So there's a lot of new entrants into the market. You know, Vanguard is obviously a new entrant into the market, and they've done tremendously well in their product. People see that, and a lot of these big companies are starting to get involved. Yes.
PIMCO is a good example.
Exactly right.
PIMCO is a great example of that.
PIMCO, yeah, the bond fund. Nitin, I'll get to Balaji after you, but give me the Indian perspective. Do you feel that this is a USP for an Indian asset management company like yourself? You're starting out, you're not going to go the conventional route, you're going to leapfrog a generation of asset management. Is that your thought process?
At least I'm betting on that, clearly. I think the penetration has obviously been much lower than in the US. So less than 1% of our AUM of the mutual fund industry is right now in ETFs, gold included. If you take gold out, it's much lower. So I think there is two sides to every coin. Part of the reason is that they haven't been offered seriously because of this whole dichotomy about active managers won't offer ETFs because it conflicts with the existing play of business. And part of the reason is there isn't enough product out there. So when I saw David's slides, one of the things I told him is that the first point you have there, which is that the market is saturated with ETFs, is actually exactly the opposite here. There isn't enough product out there. So I think our bet really is that we'll probably see this trickling up. In Asia right now the average is 4%. In US the average is 10%. In Europe the average is 6%, and we are less than 1%. And